Welcome to the debate. Welcome to the research desk. The central question before us today really cuts to the absolute core of capital allocation in this decade. We have to determine whether investors are currently pricing real, durable, artificial intelligence fundamentals, or
Or if they're just trading a story, right?
exactly, whether they are simply trading their position inside a reflexive narrative. We're analyzing this dynamic where, story, price, and liquidity reinforce each other entirely before corporate earnings can possibly catch up to equity valuations. Look, we are looking at a fundamentally split-screen market right now.
Yeah, it's incredibly stark.
It is. In the exact same 12 months that NVIDIA surged over 400%, the broader software sector quietly incinerated roughly $1 trillion in value. $1 trillion. This is not arbitrary market confusion.
No, not at all.
This is capital sorting. We are witnessing a strict hierarchy of narratives being established around scarcity, monetization, and corporate survival. My position is that artificial intelligence represents a genuine platform shift. The early infrastructural value capture we are seeing is intensely real. Capital markets are currently acting as engines, not just mirrors, using high valuations to aggressively finance genuine compute build-out and future earnings power.
I come at it from a different way. Look, the market is committing the classic recurring error of technological revolutions. It is systematically conflating technological truth with investable truth. The split-screen reality you describe, that's merely the initial fracturing of a unified thesis. At the application layer, dangerous reflexivity is actively pulling forward enterprise demand, right? It's inflating terminal value assumptions and completely masking severe structural margin destruction.
I see why you think that, but let me give you a different perspective on that structural piece.
Well, hold on. Let me just finish the thought on the infrastructure build-out. It is undeniably real. Yes, but pricing decades of flawless execution into present-day multiples, that transforms a valid technological thesis into a highly fragile financial instrument. We are watching the narrative outrun the underlying unit economics.
Okay, so let's establish the common ground here regarding the physical reality of this shift. We both concede that artificial intelligence is a real technological transition, right? It's not hypothetical.
Yeah, of course. Real workloads, measurable enterprise spend, demonstrable productivity gains.
Exactly, and acute infrastructure bottlenecks. Large language models, specialized silicon accelerators, hyperscale cloud capacity expansion, and, localized enterprise deployments are generating measurable commercial behavior today. Furthermore, we really have to acknowledge a historical reality here. Genuine platform shifts universally look bubble-like in real time.
They do, but that doesn't mean the bubble won't pop.
True, but capital markets routinely overfund the correct idea. They frequently misidentify the ultimate corporate victors, and they subsequently punish both the outright frauds and the future industry champions alike during the inevitable consolidation phase.
Look, the critical element of our common ground is understanding the mechanical, causal nature of narrative within capital markets. Narrative is not merely background noise or retail investor sentiment. It is a primary driver of corporate fundamentals.
You're talking about reflexivity.
Yes, absolutely. When we synthesize George Soros' theory of reflexivity, Charles Kindleberger's Mania sequence, Hyman Minsky's financial instability hypothesis, and Robert Shiller's narrative economics, a highly predictive, unified framework emerges. Stories actively change human behavior.
Right.
That behavior redirects massive capital flows. Those capital flows then alter the underlying corporate fundamentals, effectively making the original story true, either temporarily or permanently. Soros recognized that market prices do not passively reflect an objective reality. They actively construct it. Reflexivity is a feedback loop.
It literally builds the asset.
Right. When an AI startup with negligible revenue receives a multi-billion-dollar private valuation, that valuation provides the collateral and the currency to purchase the tens of thousands of graphics processing units required to actually build their foundational model. The narrative literally funds its own realization.
But that is the precise mechanism of capital formation. The market provides the equity to build the asset.
It's a feature, not a bug.
Yes, but Kindleberger maps the psychological sequence of this mechanism, right? Displacement, boom, euphoria, distress, and revulsion. The displacement was the initial realization of generative capabilities. We are currently navigating the transition from boom to euphoria.
I'd argue we're still firmly in the boom phase, building the base.
Well, Minsky adds the crucial financing dimension to this sequence, demonstrating how stability organically breeds instability. Market participants migrate from prudent capital structures, where operational cash flow services the debt, to highly fragile structures. They rely entirely on continuous equity issuance at inflated multiples just to maintain their operational burn rates.
Shiller's contagion model.
Exactly. Schiller demonstrates how these financial narratives operate exactly like epidemiological contagions. The story bypasses traditional discounted cash flow analysis and spreads based on transmission rates rather than mathematical validity.
Okay, and I understand the theoretical application there. The challenge for the institutional investor is differentiating between the structural overfunding of a necessary technological base and actual systemic fraud. Overfunding is a necessity of capitalist infrastructure development.
I wouldn't say necessity.
I would. Markets must provide excess, speculative capital to solve massive engineering bottlenecks. The capital that flows into these data centers and silicon fabrication plants is attempting to discover the correct configuration of the global economy's future architecture. The fact that capital markets routinely misidentify specific corporate winners does not invalidate the structural soundness of the underlying investment cycle. It simply demands rigorous security selection.
Rigorous security selection becomes a mathematical impossibility when the entire sector's cost of capital is distorted by narrative contagion. I mean, the distinction between productive overfunding and systemic fraud becomes entirely irrelevant to the portfolio manager who suffers a 70% drawdown when the multiple compresses.
But the physical asset remains.
The market's primary function is capital allocation, and when narrative dominates the pricing mechanism, malinvestment scales exponentially. The billions of dollars directed toward redundant foundational models or thinly veiled software wrappers entirely dependent on third-party APIs represents a massive misallocation of resources. That capital allocation is driven purely by institutional fear of missing out, not by rigorous analysis of return on invested capital.
Let us transition directly to the components of the bullish argument then. The strongest institutional bull case relies on three distinct pillars: material present tense utility, the historical electrification and infrastructure analogy, and the mechanics of healthy productive reflexivity.
Okay, let's hear it.
Let's examine the first pillar, utility. We are not analyzing companies operating with merely a website URL and a marketing slogan. The modern artificial intelligence ecosystem is built on mission-critical semiconductors, unprecedented global data center expansion, and measurable automation gains in enterprise environments. We are seeing thousands of hours of redundant coding, legal discovery, and customer service labor automated efficiently.
Present tense utility is not synonymous with defensible profit margins. I mean, a product can be incredibly useful to society while simultaneously destroying the capital of the investors who funded it.
That depends entirely on where the company sits in the value chain, which brings us to the second pillar. The appropriate historical analogy here is the electrification of global industry. In major platform transitions, the initial durable victors are exclusively the suppliers of enabling infrastructure.
The pick and shovel play.
Exactly. It was not the factory owners who captured the initial wealth of electrification. It was the manufacturers of copper wiring, industrial generators, and electrical turbines. This maps directly onto semiconductor capital equipment providers, designers of specialized compute chips, and the hyperscale cloud providers operating the modern digital grid. The early capital in a platform shift accurately flows to the providers of the physical foundation.
And the third pillar.
The third pillar is healthy reflexivity. Rising equity valuations fund rapid hardware research cycles and broad deployment. Capital markets are aggressively accelerating the industrial build-out of the 21st century, pulling a decade of necessary capital expenditure into a condensed 3-year window.
We must test that first pillar regarding utility and margin defense. Just because a tool has utility today doesn't automatically mean the company building it can defend its profit margins tomorrow. If the fundamental architecture relies on hardware that depreciates rapidly, The capital expenditure cycle becomes a permanent treadmill rather than a one-time structural investment.
Allow me to inject the exact, verified data defining this fundamental explosion to counter that. NVIDIA's revenue accelerated from $10.9 billion in 2020 to $60.9 billion in 2023.
Yeah, the growth is staggering.
And more critically, they achieved and maintained gross margins above 60%. This is not a theoretical projection. This is the stark, realized contrast between a corporation selling an absolute hardware bottleneck, the GPU, and an AI-enabled software wrapper possessing thin product differentiation and negative free cash flow.
But is that margin?
Wait, furthermore, direct enterprise adoption is growing above 20% year over year. That enterprise budget allocation is the ultimate truth serum. When chief information officers transition from experimental research budgets to core operational integration, it validates the massive infrastructure spend occurring at the hyperscaler level.
Look, the fundamental question regarding your bull case is the long-term sustainability of that specific dataset. I must push back using the exact framework you just established. Is a gross margin above 60% in a capital-intensive hardware business truly defensible long-term, or is it merely a temporary tax levied on a panicked ecosystem?
It's defensible if the moat holds.
But when hyperscale cloud providers' entities like Amazon, Microsoft, and Google are engaged in an existential arms race to secure compute capacity, they become entirely price insensitive. They're buying survival, not optimizing for immediate return on capital. That price insensitivity artificially inflates the margin of the sole supplier. However, the fundamental laws of capitalism dictate that a 60% gross margin will attract relentless, exceptionally well-funded competition. Custom silicon initiatives from every major cloud provider are explicitly designed to compress that exact margin.
Custom silicon is a factor, sure, but replacing generalized, parallel computing architectures with application-specific integrated circuits is historically a slow, highly frictional process.
It is frictional, but it is inevitable when the financial incentive is this extreme. Furthermore, we must dissect your statistic regarding the 20% enterprise adoption rate. An adoption rate of 20% year over year is optically impressive, but it is currently heavily subsidized by vendor credits, promotional pricing, and pilot program budgets designed to capture market share.
It's seed funding the ecosystem.
Right? But when those initial pilot programs expire and require hard return on investment justification to scale across an entire organization, the corporate willingness to pay that temporary ecosystem tax will evaporate. Enterprise software budgets are not infinite. They operate as a zero-sum environment. Every dollar allocated to an AI copilot must be extracted from another software vendor.
Well, the defense of that hardware margin lies in the profound ecosystem lock-in. It is not merely a piece of manufactured silicon. It is a proprietary software architecture that developers are tethered to. Compute Unified Device Architecture, or CUDA, functions as a highly defensive moat. It is the dominant software layer that developers universally utilize to communicate with the hardware. But, this naturally transitions us into the core arguments of your bear case. You are asserting that possessing the right technology does not excuse the wrong equity price or the wrong market timing.
Exactly. Revenue beneficiaries are absolutely not automatically value capture beneficiaries. The most profound risk facing institutional and retail investors today is the conflation of technological inevitability with investment returns. We must consider the definitive narrative anchor of the internet era, pets.com.
The classic case.
Right. The macro narrative of the late 1990s was a simple, declarative statement. Everything will be online. That statement was entirely factually true. It was a correct technological thesis. Yet, pets.com went from its highly celebrated initial public offering to complete corporate liquidation in exactly 9 months.
Well, because the unit economics of shipping heavy bags of dog food via courier negated the cost savings of eliminating the physical storefront.
Precisely. It was essentially vaporware equipped with a recognizable URL and a marketing slogan. But the structural failure was tied to the physical constraints of the era. The infrastructure of 1999 dial-up modems, fragmented logistics networks, and nascent digital payment gateways simply could not support the economic reality of their business model. The technological truth of the internet offered absolutely zero protection against total capital destruction. The math of the physical world broke the math of their financial models.
And you see that mapping to AI?
I see direct parallels today. We have massive physical constraints regarding data center power scaling, grid capacity, and latency that threaten to break the financial models of application layer AI companies.
But look, the failure of a single, poorly constructed retail operation operating ahead of the necessary infrastructure does not negate the ultimate value of the underlying digital network. Amazon survived that exact same physical constraint environment to become a foundational pillar of the global economy.
Amazon survived because of aggressive capital restructuring and an eventual pivot to cloud computing, not because their original retail margins were initially sound. But if you want a broader structural example, let us examine a genius operating in a different century. Let us review the case of Isaac Newton and the South Sea Bubble.
1720.
In 1720, yes, the South Sea Company assumed the national debt of Great Britain. They utilized the highly compelling state-sponsored narrative regarding exclusive trade monopolies in South America. The narrative generated a massive speculative frenzy across all classes of British society.
And Newton bought in?
Isaac Newton, arguably one of the greatest analytical and mathematical minds in human history, observed this frenzy. He recognized the fundamental irrationality, but the social contagion was overwhelming. He invested, capitulated to the mania, and ultimately lost £20,000, a devastating sum. His final assessment remains the definitive warning for all quantitative and fundamental investors. Newton concluded, too late, that he could calculate the motions of the heavenly bodies, but not the madness of people. The madness of people is the unquantifiable variable that consistently destroys rational pricing models during a profound technological boom.
The madness of crowds is a documented recurring phenomenon, but it does not erase the eventual capitalization of the underlying asset class. I mean, the debt conversion mechanisms utilized by the South Sea Company eventually established a foundation for modern sovereign debt markets.
It established the foundation for the state, sure, but it entirely erased the capital of the investors who participated at the peak. The historical anchors demonstrating this dynamic are undeniable. Look at Japan in 1989.
The real estate bubble.
The global narrative of Japanese economic supremacy, combined with structural real estate scarcity and financial deregulation, drove asset valuations to such extreme deviations from cash flow that the Imperial Palace grounds in Tokyo were literally valued higher than all the real estate in the state of California combined. The narrative was overwhelmingly powerful. The pricing was pure mathematical fiction. Look at 2008. Collateralized debt obligations built on tranches of subprime mortgages were universally rated AAA by the most sophisticated quantitative rating agencies in the world. They utilized complex mathematical models to justify the elimination of risk, right until reality intervened. The underlying mortgage defaults correlated, and the global financial system imploded.
Those are examples of credit and real estate bubbles, which operate on pure financial leverage. Technology platform shifts operate on fundamental productivity enhancements.
The asset class changes, but the mechanism of multiple expansion remains identical. Look at the pure reflexive volatility of Bitcoin over the past decade. We have witnessed cycles violently swinging from 20K down to 3K, then exploding to 69K, collapsing rapidly back to 16K, and then surging to 100K and beyond. Each specific cycle is driven purely by narrative adoption, regulatory sentiment, and massive liquidity injections entirely detached from traditional corporate cash flow generation or dividend yield. A compelling story creates a new financing channel.
Which funds the fundamental development.
It validates the original story, yes. Then, inevitably, the market discovers that actual demand was artificially pulled forward. Terminal value assumptions were pure fantasy, and the asset must be violently repriced.
Let me introduce a structural foil to your specific examples, utilizing a company outside the realm of artificial intelligence, but deeply embedded in narrative economics. Consider WeWork. In early 2019, WeWork achieved a private market valuation of $47 billion.
A staggering mispricing.
It possessed a real, tangible underlying business, commercial real estate leasing, and a highly potent, charismatic narrative framing it as a scalable, tech-enabled platform, rather than a traditional, capital-intensive landlord. The narrative effectively obscured the fundamental mismatch between their long-term lease liabilities and their short-term rental assets. This perfectly demonstrates how a real business with a powerful story can significantly outrun its durable economics.
Right, and it collapsed.
However, the regulatory system eventually functioned exactly as designed. The initial public offering process forced a strict confrontation with public market disclosure requirements. Transparency initiated a massive, immediate valuation reset. The capital markets self-corrected, identifying the discrepancy between narrative and cash flow before the broad retail investor base was entirely decimated.
The private market investors were still decimated.
Yes, but the contagion was contained. The question for you regarding the current artificial intelligence ecosystem is this: how do you explicitly separate the governance dimensions, such as data privacy, copyright infringement, and broad global regulation, from the hard physical capital expenditure constraints like gigawatt energy capacity and specialized skilled labor? The physical constraints are measurable. The regulatory constraints seem highly abstract.
You absolutely cannot separate them, because regulation is not simply background noise or an abstract legal theory. It is the monetization architecture itself. Governance dictates the strict parameters of corporate value capture. A foundational generative model trained on billions of parameters of copyrighted material currently faces existential legal liabilities.
Fair point.
If appellate regulatory bodies determine that machine-generated output cannot be copyrighted by the end user, or that the initial training data requires stringent retroactive licensing agreements and royalty payoffs, the entire gross margin structure of the application layer immediately collapses. Energy capacity naturally dictates the physical limit of model training and deployment, but regulation dictates the legal limit of monetization. If a specific artificial intelligence technology cannot be legally integrated into an enterprise workflow due to strict data sovereignty laws or privacy mandates, its raw physical capabilities are financially irrelevant. The governance framework establishes the toll roads and the pricing structures upon which the technology must travel. If the government refuses to grant the charter for the toll road, the infrastructure investment is stranded.
That analysis requires us to heavily scrutinize the best historical analogies available to us. This is how we define the macroeconomic process of discovering the future expensively. We must move beyond theoretical frameworks and examine how the market has historically priced foundational infrastructure during technological transitions. The most critical, structurally accurate analogy for our current infrastructure phase is Cisco in the year 2000.
Cisco is the perfect, terrifying encapsulation of the current market dynamic. It requires a deep analysis. By March 2000, Cisco briefly exceeded $500 billion in total market value, making it the most valuable company in the world at that moment. The underlying institutional investment thesis was utterly flawless. Investors correctly understood that the internet's physical backbone, the routers, the switches, the optical networking gear, would be the absolute critical infrastructure of the new global digital economy. Every single packet of data would inevitably flow through their proprietary hardware.
Exactly. They accurately identified the platform shift, they recognized the foundational layer, and they correctly identified the dominant corporate player within that layer. Their core thesis was entirely validated by the subsequent 2 decades of technological history.
And yet, they were catastrophically wrong on the stock. From that March peak, Cisco equity fell roughly 80% and did not regain that specific valuation level for over 2 decades. The brutal, unavoidable lesson here is absolute. The underlying technology can be world-changing. The specific company can remain strategically central to the global economy, but the equity investment is still terrible if the narrative story outruns the discounted cash flows. Paying a peak terminal multiple, meaning pricing the stock as if it will dominate the market perfectly with expanding margins into perpetuity for an infrastructure provider exactly at the peak of a global capital expenditure cycle, mathematically guarantees negative returns.
When the telecommunications companies finished laying the initial fiber optic networks, Cisco's order growth decelerated. The company survived, but the valuation multiple compressed violently.
I accept the historical data, but I strongly challenge the direct mapping of the Cisco analogy onto the modern semiconductor landscape, specifically regarding NVIDIA in 2026. Cisco manufactured and sold hardware built primarily on open standard internet protocols. A network router from Cisco could theoretically be replaced by a router from Juniper Networks.
The switching costs were high, though.
High, but they were not insurmountable. NVIDIA is structurally different due to its profound, multi-layered ecosystem lock-in. Compute Unified Device Architecture is a proprietary parallel computing platform and programming model. It is the dominant software layer that millions of developers actively utilize to optimize artificial intelligence workloads. Switching away from NVIDIA hardware to alternative silicon requires rewriting entire complex software stacks. That immense frictional cost creates a defensive moat that Cisco simply never possessed. The terminal multiple assigned to NVIDIA today might actually be justified by the long-term durability of that software-enforced hardware monopoly.
Moats are consistently breached by economic necessity. When the ecosystem tax becomes fundamentally too high for the participants to bear, the broader industry aggressively funds the alternative. Open-source compiler initiatives and abstraction layers are specifically designed to break that CUDA dependency. But if we are examining the systemic overbuilding of physical infrastructure, let us look backward to the 1845 United Kingdom railway mania.
The railways.
During this period, Parliament approved 272 separate railway acts in a single calendar year. The underlying technology undeniably transformed the economic geography of Britain. It drastically reduced raw material transport costs, created unified national markets, and standardized time across the country. But the speculative overbuilding, driven by massive retail investment and cheap credit, resulted in immense, widespread capital destruction. The highly profitable, localized geographic monopolies envisioned by the original promoters were rapidly destroyed by the construction of parallel rail lines and the resulting vicious price competition for freight.
Which precisely mirrors the current artificial intelligence capital expenditure boom. But I frame that as a long-term positive. It is capitalism discovering the future expensively. The immense capital is sunk permanently in the ground, or in this specific case, into the concrete and cooling systems of the gigawatt data center. The broad social and economic utility is ultimately maximized, even if the initial equity holders are severely diluted or entirely wiped out during the consolidation phase. The physical infrastructure remains in place to power the next distinct phase of global economic growth. The investors absorb the localized risk, society absorbs the systemic reward.
That's an excellent framework for an economic historian, but it is deeply cold comfort for the fiduciary managing a retirement portfolio. The third necessary analogy solidifies the severe risks specifically to the retail investor. The RCA radio mania of the 1920s.
The broadcast boom.
Yes, the historical stop chart of the Radio Corporation of America traces a meteoric rise from about $1 per share to $573, before collapsing violently back down to $2.62 in the aftermath of the 1929 crash. The underlying technology of broadcast radio fundamentally changed mass culture, accelerated news distribution, and created the modern entertainment industry. The societal impact was permanent and immeasurable, yet the equity market utterly destroyed the late buyers who purchased based on exponential growth extrapolations. The undeniable utility of the broadcast medium offered absolutely zero protection against the brutal contraction of the valuation multiple when the broader liquidity environment changed.
This historical perspective leads directly into the deepest unresolved operational issue in this entire macroeconomic cycle. We must parse the critical difference between who simply generates the gross revenue versus who actually keeps the net operating margin.
Exactly. Revenue generation is currently masking margin degradation. The operational frictions in artificial intelligence deployment are severe and compounding rapidly. We are witnessing intense, highly funded open-source pressure. Foundational models, which cost hundreds of millions of dollars to train,
are facing rapid commoditization as open-source alternatives achieve performance parity with proprietary, closed-source models at a fraction of the licensing cost.
Obliterating pricing power.
It completely obliterates corporate pricing power at the foundational layer. Furthermore, enterprise customer bargaining power is massive. Institutional clients are not locking themselves into single-vendor model ecosystems. They're actively utilizing intelligent routing architectures to direct specific computational queries to the cheapest adequate model available at that precise millisecond. Add to this the crushing burden of energy-intensive inference costs.
We'll explain the specific mechanics of that inference cost burden, because it deviates entirely from the traditional software model investors are accustomed to.
Traditional software operates on a model of zero marginal cost. Once a line of code is written, distributing it to one user or 1 million users costs essentially the same amount. Artificial intelligence completely breaks this paradigm. Every single time an AI model generates a text response, an image, or a line of code, it consumes significant, measurable compute cycles and electrical power. AI has a heavy, permanent, variable cost of goods sold. The diffusion of AI capabilities into broad society simply does not equal excess, defensible returns for AI equities. The top-line revenue ultimately flows to the utility company providing the electricity and the semiconductor manufacturer providing the chips. The operating margin is systematically destroyed by the brutal hardware depreciation cycle.
I must press you on the reality and durability of enterprise switching costs, though. You assert that foundational models are rapidly commoditizing, which is mathematically and empirically true at the raw intelligence layer. However, corporate toll takers operating with deeply embedded workflows and distinct regulatory compliance advantages will absolutely maintain their pricing power.
I disagree.
Consider an enterprise software provider that has successfully integrated AI directly into a complex workflow involving proprietary corporate data, rigorous identity access management, and strict regulatory compliance controls. That provider cannot be easily or cheaply displaced by a slightly cheaper generic open-source model. The primary switching cost for the enterprise is not the simple API integration. The true switching cost is ripping out the customized governance, security, and data lineage infrastructure that surrounds the model. Those embedded toll takers will successfully capture and defend the margin even as the raw foundational intelligence layer commoditizes directly below them.
If the underlying intelligence layer commoditizes to zero, the software wrappers lose their premium pricing justification entirely. Why pay a massive subscription premium for an embedded workflow if the core utility driving that workflow is available essentially for free?
But this debate over margin capture naturally moves us to the synthesis of our arguments. We are examining distinct layers of capital investment and narrative reflexivity. Artificial intelligence is a real platform shift currently being priced through a highly unstable narrative mechanism. We must strictly analyze this dynamic in separate, distinct layers to avoid generalizations. At the underlying physical infrastructure layer, we are currently witnessing highly productive reflexivity. Astronomical equity valuations directly finance the complex construction of silicon fabrication plants and massive gigawatt data centers. Returning directly to Soros's framework, the market perceptions are actively producing the hard fundamentals.
It creates the reality.
Yes, the massive capital raised at historically high valuation multiples creates the physical, concrete reality of the global AI build-out. The infrastructure is being willed into existence by the cost of equity. At the software application layer, however, we see dangerous, highly destructive reflexivity. This is where inflated valuations are utilized aggressively to pull forward subsidized customer trials and justify astronomical revenue multiples on software businesses with fundamentally weak gross retention rates. This is precisely where Minsky's framework applies with terrifying accuracy. The sector financing is rapidly migrating from prudent, cash flow-backed operational structures to fragile speculative structures entirely dependent on continuous venture capital equity issuance.
We can map this specific software versus hardware dynamic directly onto Kindleberger's established phases: displacement, boom, euphoria, distress, and revulsion. The technological displacement was the mainstream introduction of highly capable generative models. The boom phase encompasses the massive, ongoing global capital reallocation we are currently witnessing.
The core debate between institutional strategists centers on whether 2026 represents late-stage euphoria or merely a high-conviction, early-stage build-out phase.
Right.
Given the extreme, historically unprecedented multiple dispersion between hardware suppliers and software implementers, I argue we are actively entering the distress phase for the application software layer, while the physical infrastructure layer teeters dangerously on the absolute edge of peak euphoria.
Let me introduce Robert Schiller's specific concept of contagious stories compressing time to challenge your timeline. Schiller argues that powerful economic narratives spread functionally like epidemiological viruses. The dominant narrative that AI changes absolutely everything forces market participants to aggressively discount 10 years of projected mathematically flawless earnings into today's immediate stock price. The temporal compression of future value into present price is total. My core question to you regarding this time compression is this: where exactly does the breaking point lie? When does the future simply refuse to be pulled any further forward by the narrative? The mathematical breaking point occurs the exact moment the second derivative of corporate growth turns negative. When the rate of revenue acceleration slows, even if absolute top-line growth remains robustly positive, the fragile mathematical models supporting those highly compressed terminal values simply shatter. The multiple relies on acceleration, not just velocity. The specific moment enterprise chief financial officers shift their budgets from experimental R&D mandates to mandatory ROI justification, the time compression violently snaps back. That snapback does not result in a gentle plateau. It results in brutal, systemic multiple contraction across the entire sector. This critical assessment requires us to translate our macro analysis into actionable, strict directives. This is the strategist briefing segment, focusing on what this macro environment means for institutional and retail portfolios. The tactical directives here are rigid, highly specific, and driven entirely by the empirical datasets we have rigorously analyzed today.
Point 1. Avoid broad, indiscriminate sector exposure. Investors must actively underweight broad AI-themed exchange-traded funds by 10% over the next 12 months. Mechanically packaging scarce, highly defensible infrastructure companies alongside commoditized, low-quality software application wrappers is a guaranteed recipe for systemic capital destruction. It is the ultimate financial vehicle for narrative excess, designed to harvest management fees rather than generate alpha.
Point 2. Overweight foundational physical infrastructure by exactly 7% for the next 12 to 18 months. This is a highly targeted, strategic allocation strictly toward the definitive physical industry bottlenecks. However, this specific position requires aggressive, continuous monitoring. You must reassess and immediately reduce this infrastructure exposure if enterprise AI adoption slows below 20% year-over-year growth for 2 consecutive financial quarters. That specific 20% threshold is the absolute demarcation line separating a structural, fundamentally justified build-out from sheer narrative exhaustion.
Point 3. Demand empirical proof in non-hyped legacy sectors. The true durable indicator of technological diffusion is industrial application, not software as a service press releases. Look specifically for AI integration driving more than 20% revenue growth or severe cost reduction in mature legacy industrial businesses. If the underlying technology cannot generate a measurable 20% operational uplift in complex logistics, heavy manufacturing, or traditional global supply chain management, then the macro narrative is fundamentally failing to execute on its promises of global productivity enhancement.
Point 4. Prefer proven, cash-generating monetizers. Strictly avoid pure-play AI equities with a price-to-sales ratio above 20x combined with negative free cash flow. Paying 20 times top-line gross revenue for a structurally cash-burning entity in a high-interest rate, highly competitive corporate environment is statistically ruinous. You must stick to entities demonstrating tangible operating leverage where revenue scales significantly faster than the variable cost of compute.
Point 5. Treat global regulation as an active, quantifiable portfolio variable.
Systemic sector risk rises dramatically if major global regulatory blocs, specifically the United States, the European Union, and China, fail to converge on basic interoperable safety, privacy, and copyright standards. Fractured, localized regulation severely destroys the total addressable market for scalable software deployment. You must mathematically adjust your discount rates accordingly, based on the specific legal jurisdiction of the company's primary revenue base.
Point 6. Watch corporate capital allocation with extreme, unforgiving vigilance. Be highly skeptical of aggressive mergers and acquisitions targeting unproven, pre-revenue startups, or bloated executive compensation packages disguised as necessary talent retention tools. Favor companies demonstrating high sustained research and development intensity. Internal R&D fundamentally builds the long-term defensive moat. Aggressive M&A often merely buys the short-term narrative to placate institutional shareholders.
Point 7. Keep substantial dry powder for the inevitable post-narrative repricing. The most asymmetric, generational returns in financial history consistently occur immediately after the initial narrative bubble fractures. This is the period when truly exceptional, durable assets are indiscriminately liquidated by margin calls alongside the outright frauds. You must maintain strict liquidity constraints to capitalize on that widespread sector distress.
We have reached the conclusion of our analytical briefing. To formally synthesize our structural positions based on the data presented, I maintain that the massive artificial intelligence build-out currently underway represents a structurally sound, historically unprecedented infrastructure phase. The rapid capital formation at the foundational, physical layer is highly productive and is actively generating real, measurable economic value despite the undeniably time-compressed valuation multiples. The core engine of global capitalism is functioning exactly as it should to aggressively solve a massive, civilization-level computational bottleneck.
And I reiterate my structural warning. Buying the crowd's confidence invariably ends in a violent, mathematically unavoidable repricing. The fundamental separation between technology's truth and investable truth remains the most dangerous recurring trap in global capital markets. The compounding operational frictions, structural margin degradation, and unavoidable regulatory realities will inevitably fracture the growth narrative at the application layer. Simultaneously, the physical infrastructure layer is currently mathematically priced for a flawless decade-long execution that macroeconomic reality simply will not permit.
The mistake in every mania is the same. Investors think they are buying the future when they are often just buying the crowd's confidence in the future. AI is real, but in 2026, much of the market is still trading the story faster than the earnings.
This is the research desk officially signing off.